Hi guys, please like, share and subscribe and contact this number if you want lectures related to any CM, CS or CB subjects. Thank you. The next thing I would want to talk about is Fidentia X and blockchain-based tradable insurance, right? So that sounded like a very interesting and appealing concept to me. So please tell me, like, what are you guys exactly doing? And you are you one of the founders there, or you're just like a consultant?
So Fidentia started around 2017, and it's I think they're no longer very active in the operations, and my arrangement with them also stopped year and a half ago. Because they were in my head. I mean, the idea is nice and still novel and makes sense to me. The team struggled a lot because of not being able to find right blockchain technology partners. Because and that it was early 2017, right, when people were still trying to figure out what blockchain is.
Right. It was
and
fairly
being able to find
at that point.
So trying identifying partners who could develop a solution was difficult, and a lot of money was spent into technology development, but the output wasn't quite delivered by the partners, and hence the team and the projects as well. So it's still it is on, but in a very dormant stage.
Right. But then let's just talk about the product itself. How how much potential do you see in tradable insurance platforms, and what value does blockchain add to it?
Yes. So let's also then briefly understand what tradable life insurance is, right? This is primarily for products which have investment components like endowment, largely endowment products. What really happens, right? What one is really trying to do is squeeze a value or extract a value from the surrender value, or the difference in surrender values that an insurance company offers, and what a new buyer of the insurance product or a buyer in the secondary market could offer. So in an endowment setting, let's say if you buy an endowment product for 10 years duration and choose to discontinue it, surrender it, let's say after 3 years. In most cases, and pretty much across the globe, what you get is about 30% of the premiums that you paid over 3 years, which is roughly one premium out of 10 premiums, right? But let's say if someone comes in, what he's gonna get is and every endowment product that you see, you are definitely going to, the maturity value is definitely going to be higher than the total premiums. So IRR is certainly positive, right? When you sell it after 3 years, you pay 3 premiums and get one back. So IRR is negative. So the difference between this minus 2-3 odd percent IRR to 3-4% plus 3-4% IRR is where you could play around, right? So a new person comes in, okay, says that, okay, insurance company is paying you one equivalent of one premium. Let me pay you 1.2 premium. You still make money. Since I pay 1.2 premium now, and next 7 premiums for next 7 years, and I get more than 10 premiums, I also make money, right? Why an insurance company can't do this? Because insurance companies end up spending a lot on acquisition. So they pay commissions in the first year, they have administration charges. So they can't return the entire premium because some part of it is already spent, and which insurance company was hoping to recover over 10 years through investment, right? But since you terminated the contract early, they can only give you what they can afford to give you. Right. So there's clear meat, clear juice line there, and makes sense to extract it.
Sure.
Right. What blockchain does is, let's say if I were to, I was the original buyer of the insurance policy and I decided to not continue it, and I want to now sell it to someone. How do I find that someone? Right? How do I figure out that this someone is going to, if I assign my contract to him, which means he becomes the final beneficiary of this product also pays a premium, becomes a beneficiary, I would get my 1.2 premium back, right? So because there are two steps. I first assign and then get a premium, or I first get premium and then assign. So either party could default. What blockchain does is, okay, something called smart contract, where you say, okay, I assign, and this would be released to you only when you give me 1.2 premiums. So there is an automatic contract that is signed, which is triggered by which is triggered by me assigning contract to you and you paying me 1.2 premium. If you default, you don't get the contract. If I default, I don't get the money, and I don't need to rely on a third party to do it, because that is how blockchain is structured.
So it's self-enforcing in some way.
Right? Yeah, it's equally right. I mean, let's take example of which is more relatable, right? Flight delay insurance. What it says is you buy a policy before you board the flight, 2 hours, 3 hours, 10 hours, a day before. If your flight get delays by, let's say, half an hour or 2 hours, you get money back. You get your, the claim is automatically triggered, you get X amount of money, right? This is something which can happen without blockchain as well. I mean, there's no reason why this can't happen without blockchain, right? Insurance company could figure out that you bought a policy, the flight got delayed, and initiate a claim. They could do it themselves without having to do it over blockchain. And there are companies who have done it without blockchain. But what blockchain means implies is that once I have bought the contract, there's nobody could play around with it. There's nobody who could change it. And Oracle, which is a third-party software, which would run and see, okay, if the flight got delayed, if it got delayed, it would trigger. The claim amount is already in escrow, and it would come to me if there is a claim. Would come to insurance, go to insurance company. There is no claim. As simple as that. Once the contract is written, you can't change it.
Right.
And hence it brings in trust even within parties who you can't trust otherwise.
Which is fine, but let me ask a couple of follow-up questions on this.
Yeah.
So first of all, for example, I'm doing the same thing for life insurance. So does the cover stay for the first life itself, or like the cover gets transferred? The cover is for the first life itself. It's only the beneficiary which changes, right?
Yeah, the cover still is with the first life, and that's and it is a problem in itself, because once how do you know that the original life insured has died, right? Because he has no interest in telling you, and that's pretty much a problem across the globe.
Right.
How people get around is
also one more thing there isn't any insurable interest, right? Which is a primary condition for life insurance, isn't it? Like if I buy it from a stranger, I don't have an insurable interest. Like I'm just betting on a stranger's life somehow.
Yes, you are, but in several, and that's where the conflict comes in, right? For example, it is not allowed in India. It is allowed in Singapore. It is allowed in US. So in US, their Supreme Court passed a judgment that after the policy has been bought, it has been bought from the insurance companies, it becomes more like an asset which could be sold. And that's where insurable interest doesn't come in picture. It becomes like you bought a car and you want to sell it because there's a meat in it.
Right.
So I mean, and it could get tricky, right? So let's say if you buy my policy, kill me, you get all the money, or vice versa.
And it gets much more complicated in terms of a term insurance, right? Because then you're exactly wishing for that person to die, or otherwise you lose your money.
Right. So so generally term insurance are not tradable because there isn't any surrender value. So there's no reason why someone would sell term insurance.
Right.
Trade term insurance. It's only with the savings product.
What I've read on this is for a lot of critically ill people, there are some contracts called as viticals, which are sold in the US. And they are essentially term assurance or sort of whole life assurance contracts, right? And what they would do is like someone has been diagnosed with cancer and they have their life insurance policy. So now they want to live a comfortable life, right? For the remaining time they have. So they would transfer their policy and they would receive a substantial amount of money. And whenever they die, the investor who has invested in their life receives the money. But then eventually what happened was that treatments evolved over time. Like these policies were very, very popular in the 90s. But then, it was for AIDS. It was sold a lot.
Exactly.
But then for AIDS, the treatment evolved so much that these people were not dying. And then the investors were filing suits in the courts that, my agent promised me this much of a return, but I got nothing. I, in fact, lost money because the person survived. So like some moral conflict there.
Yeah, there is. But then let's also look at from other perspective, right? So someone who is terminally ill needs money right now to be treated, right? He may not be very interested in getting money after he has died, especially if the family is self-sufficient, right? And hence he is a reason to sell it off to someone, utilize that money to treat himself.
So yeah, that's actually very innovative, like the kind of work you're doing. Okay, so we have discussed a whole lot of things. Let me just move on to something else. So in terms of the Indian actuarial profession, right? So you have been observing it for quite a while now, right? How do you think it has evolved since we last spoke? So the last time we spoke, we discussed that there were a lot of freshers and the number of jobs were quite limited. Freshers had a lot of exams. Do you think that has changed over the last 3-4 years? Do you think it has gotten better?
Yeah, I am not very sure if I'm close enough to comment on it, but I can talk about a few things that have happened. I think uh, the the challenge around oversupply, especially at amongst young actuarial talent, is now recognized, and there has been some action taken by the institute as well, right? So there is now a working party which is working on wider areas. There's a working party which was focused on getting introducing actuaries to banking domain, and equally there's something that I'm working with institute to see how actuaries could become part of mainstream Insurtech revolution, right? So the point, okay, so what has changed? There has been acknowledgement. There has been some actions taken. Whether we see results or not, I'm not the best person to comment it. But would we see something in future? The answer is yes.
Okay. And how do you think the profession in general has changed? Do you see any like evolvement in the kind of work we do? Do you think more people are now working in the non-traditional areas, including Insurtech, in finance and banking?
Yeah, I think the profession has been growing in many ways. So both in terms of counts, the quality, the type of work we do, and if we talk about specifically about Insurtech, which is where my interest lies, there are at least 3 or 4 actuaries who are now Insurtech co-founders. So there has been fair amount of increase in terms of diversification in terms of type of work we do, the quality of work we do as well. So since I've been working with uh, Indian actuarial professionals as well, I see a fair amount of change in terms of the quality of work that has changed over a period of time as well. So yeah, that's the, and equally on the regulatory side as well, right? Regulator launched Sandbox, and there has been several. There was a lot of interest among insurers and insurtech to test their product in the sandbox. So uh, in my head, we are only going north. We have only gone north in last 3-4 years.
Right. And like the Insurtech space itself, you think it has grown a fair bit in the last 3-4 years?
There's also an organization called India Insurtech Association, and I'm part of their executive committee, wherein I'm trying to see how actuaries could become part of Insurtech revolution, as I said. And in the same capacity, I'm working with IAI to see how IAI and Institute of and India Insurtech Association could collaborate as well. But that's really at the early stages, and I can't divulge a lot, and I can't promise a lot.
Right, but that sounds really promising, and it's really good to see that there are people like you who are being the torch bearers of sort of the insurtech revolution for actuaries. Because if you see till 2016-17 even, the kind of insurtech startups that came in India initially were mostly on the selling side and the brokerage side of it, right? So they were only using tech to sell insurance online. They were mostly aggregators. But then, do you think now more and more companies, insurtech startups are coming in, which are doing more than just using tech platforms to sell insurance? Maybe on the pricing side, maybe on the like the way the business is done.
Yeah, quite a few, I think. So there has been innovation on the underwriting side. There has been a lot of innovation on claims side as well. For example, I work with Insurtech in India now. I've been working with them for like a year and a half now, and they've been trying to. They've developed a state of the art product wherein they they standardize all the medical information that is submitted as part of claims, and they have thousands of rules that are already written in literature which they have now coded, which when passed through give you a fair indication of how much claim should be processed, how much amount, what part of it doesn't look like a genuine claim, and what part of it is certainly a fraudulent claim. So essentially, the journey is you submit your claim documents, they standardize it, convert everything into, let's say, ICD-10 codings, run rules. Now that the data, now that entire information is standardized, you could run rules which are both standard rules and also run machine learning over and above it to identify patterns, and then tell uh, the claims officer or the claims team what amount should be paid equally, whether this looks like a fraud claim or not.
Right. That sounds great. So one thing I also wanted to ask you, while I was going through some of your videos and stuff that you had written about on LinkedIn, you had talked about how you helped a gaming company design a betting engine using actuarial knowledge and skills. So what was that about? Please tell us about that.
So there's a fair, I mean, in the last GCA which happened, I talked about them in great length. So if you wish to get into details, you could go there. But briefly here, I can talk about what I did for them. So one of the key things that I did for them was design their racing algorithm. So these are virtual horses. They can't run on their own. They have to run based on an algorithm, right? And there are tons of rules around what is the type of horse, what is the bloodline, what is the genotype, essentially telling indicators which will tell what is the quality of this horse as compared to others, right? So simplistically putting, a horse which is of a very good quality is more likely to win than horses which are not of as good a quality, right? But the horses which aren't as good in terms of quality could still win. So how do you design an algorithm which factors in what we just said and come up with an algorithm wherein the race looks real and exciting? So that's one thing that I did. And these are again on blockchain technology. What I'm also now doing for them is doing their tokenomics, which means modeling how their new crypto tokens would be circulated, would be shared, would be utilized in the ecosystem.
Okay, that sounds really cool. Okay.
Yeah, and I mean, this is not trying to boast here, right? So when we started talking about tokenomics, I was very honest about that. I haven't done anything like this in past, right? So, and they said, okay, you know math. Since you have bought few horses, you have skin in the game, and honestly, nobody has got it right in the past. So since we know you, we would want to work with you and not with anyone else on something like this. So yeah, that's really talks about a lot in terms of personal branding, which everyone, whether actuary or not, should focus on.
Right. So apart from obviously your skills and the technical side of your work, it's very important to build relationships and to like inspire trust so that business comes to you.
to show up, to deliver, to be available. And yeah, basically be responsible.
Right. So I mean, I have mostly run out of questions now. So just one last thing that I would want you to talk about is like where do you see the profession going forward? And again, the same question that I asked you the last time at the end. What would be your advice to young actuarial aspirants who are just entering the profession or have passed a couple of papers and are now looking for jobs?
Yeah, so I would say develop skills and not just skills that you learn through exams. I think Python is more like Python or R is more like mandatory. Machine learning is something which one should explore, understand, get a feel for it, and if you can code, nothing like it. Because in my head, that's going to be minimum expectation in next 2, 3, 4 years. Right? So every actually would be required to do coding. Uh, and if not do actual coding, understand what is the possibility with machine learning, what is that you could do with Python in general, right? Yeah, getting first job is difficult. I had my fair bit of challenges, but what could really help is develop skills, talk about it either through LinkedIn, write a Medium post, and if you're doing something on machine learning, aspire to get your articles published in towards data science, and that would increase your chances of getting your first job. And that's where I think a fresh journey would start. I'm not saying that the learning should stop there, but that gives you that gives you platform uh, to do more and more important and exciting things.
Right. Okay, Sumit, thank you. Thanks for your time.
Yeah.
And I think it's been a great learning session. And I personally have, learned a lot. And I'm sure the people who will watch this video will learn a lot from your experiences. It's always nice talking to you and to hear about so much new, cool, cutting edge work that is happening at the forefront of innovation in actuarial science and insurance. So yeah, I mean, it's always refreshing in that sense, right?
And likewise, Romit, great talking to you. I mean, I've been speaking after a good 3, 4 years. It looks like I thoroughly enjoyed the conversation, and it was great catching up with you. And hope people watching this find this useful.